Listen to me right now. Stop scrolling. Put the phone down, because what I am about to tell you is the difference between making life-changing money over the next 9 months and missing one of the largest policy-driven wealth transfers of your lifetime. I'm Raoul Pal. I've spent decades studying macro cycles, liquidity waves, and how money actually moves through the system. I've watched governments pull levers that most people don't even know exist. I've seen how markets react before the headlines. And I'm telling you right now with absolute certainty, something massive is about to hit the US economy. Trillions of dollars, fast, in waves, and 90% of investors are going to miss it because they don't understand how this game works. This isn't politics. I don't care who you voted for. I don't care what your opinions are. I care about your portfolio, your future, and whether you're positioned ahead of the crowd. Or you re-watching everyone else get rich while you sit there asking what just happened. Because history shows us exactly what happens when this much liquidity hits the market this quickly. It creates a violent repricing of assets. It creates a feedback loop that rewards the prepared and punishes the reactive. And if you're not positioned correctly, you don't just miss a rally. You miss the compounding. You miss the early entries. You miss the easiest money. Now, before I break down the timeline, the flow of capital, the sectors that absorb liquidity first, I need you to do one thing for me. If you are serious about your financial future, subscribe. Not because I need the numbers, but because these are the moments where the algorithm buries the truth and promotes noise. This channel exists to give you the signal before it's obvious. So hit subscribe, turn on notifications, and let's get into it, because what's coming is not theoretical. It's a liquidity event, and liquidity is the only thing that matters. Now here's what most people miss: policy doesn't change markets instantly. It changes markets in waves, and those waves don't hit evenly. They hit specific pockets first, then they spread. Then the media notices, then retail chases. Then it becomes mania. And then only then people say, I wish I'd known earlier. I'm giving you earlier. So let's lay out the basic structure. If we're talking about trillions of dollars hitting the economy over a short window, that money doesn't just appear in one place. It flows through 5 distinct channels. Think of it like a storm system. The cloud forms first. Then the rain hits one region, then another. Then the whole map turns red. If you understand the order, you can ride it. If you don't, you'll be late to everything. So here are the 5 liquidity waves that matter. Wave 1. Anticipation. This is where we are now. Markets move before the money moves. Institutions front-run the flows because they know what's coming. This is where you see the shift from defensive assets into risk assets. Utilities start lagging. Consumer staples start fading. Low volatility portfolios start getting rotated out, because nobody wants safe and boring when the system is about to get flooded with fuel. Wave 2, the household surge. This is when money hits consumers directly: refunds, credits, checks, adjustments, whatever form it takes. It doesn't matter what the headline is. What matters is that money goes from promised to available in a bank account, and when that happens, the economy reacts instantly. People spend, people pay down debt, people invest, and markets move hard. Wave 3, corporate money moves, repatriation, buybacks, dividends, mergers, acquisitions. This is the wave that quietly sends indexes higher while the average person still thinks the rally is random, because corporations don't wait for permission, they just execute. Wave 4, capex and infrastructure spending. This is business investment incentives, accelerated depreciation, equipment spending. This is where the industrial complex heats up. This is where materials, automation, energy infrastructure, manufacturing, supply chain reshoring gets supercharged. Wave 5, inflation and the Fed reaction, and this is where most people get wiped out, because they think stimulus is always bullish. But if inflation rises, the rules change. Rates matter again. Bond yields matter. The cost of capital matters. And if you're positioned wrong when that switch flips, the same market that made you rich can start taking it back. So the goal isn't just to be bullish. The goal is to be dynamic, to ride the wave, and rotate before the wave crashes. Now I want to put the scale of this into perspective, because people hear trillions and their brain just turns off. So let me translate this into something real. The 2008 crisis response was enormous bailouts, liquidity facilities, rescue packages. COVID stimulus was historic. And yet we're talking about a policy-driven setup that can inject an enormous amount of capital into the system in a compressed time window. Not because the economy is collapsing, but because policy is designed to accelerate growth. That's rocket fuel on an already warm engine. And when you do that, assets don't just rise. They reprice violently. Now, why will most investors miss this? Because most investors are trained to react. They wait for the news, they wait for confirmation, they wait until it feels safe, and by the time it feels safe, the money has already been made. Let me tell you how markets actually work. The best opportunities happen when it still feels uncomfortable, when the narrative hasn't caught up, when the crowd is uncertain, when the headlines are mixed. That is where positioning matters, because by the time CNBC is telling you it's real, it's late, the easy part is over, so we don't react, we anticipate, and if you understand the waves, you can position before each one hits. Now let's get tactical, because you didn't come here for philosophy. You came for a playbook. So here it is. Wave 1: anticipation. This is when small caps begin to outperform. This is when consumer discretionary starts waking up. This is when risk appetite shifts, because small caps are the most sensitive to domestic growth and liquidity. When money hits the real economy, small businesses feel it first. They benefit disproportionately. They're ignored. Until suddenly they're not. And by then, the run is already halfway done. This is also where you watch volatility compress, uncertainty clears, the market starts leaning into risk on, now wave 2: household cash. This is the consumer surge, and we know exactly how consumers behave when sudden liquidity shows up. A chunk goes to debt repayment, a chunk goes to discretionary spending, a chunk goes into savings and investing, and a chunk goes to survival expenses. So what does that mean? It means retail and consumer discretionary benefit, home improvement benefits, travel and leisure benefits, entertainment benefits, payment networks benefit, Visa, MasterCard-style systems, brokerages benefit because people move money into investment accounts. And here's the key part nobody understands: consumer spending doesn't just boost the economy. It boosts earnings, and when earnings rise, multiple expansion follows. Then more capital chases the same stocks, and that creates a feedback loop. It's not linear, it accelerates, and the people positioned early catch the compounding. Wave 3: corporate repatriation. This is where mega caps start acting like vacuum cleaners. Buybacks, dividends, M&A. This is where you see the index grind up relentlessly. Because share count reduction mechanically lifts prices. You don't need optimism, you don't need euphoria. You just need fewer shares. And when corporations bring cash home, they don't sit on it, they deploy it. Wall Street loves buybacks. And markets love buybacks because buybacks are demand, permanent demand. This wave tends to favor large tech, large financials, dividend payers, and anything with the scale to execute massive capital return programs. Wave for capex and infrastructure. This is where industrials, materials, and real economy plays explode, because when businesses get incentives to spend, they spend immediately. Equipment, automation, data centers, energy build-out, manufacturing, infrastructure upgrades, and somebody has to supply that. This is where you see the picks and shovels outperform. Not just the sexy tech narrative, but the companies that build the foundation: engineering firms, construction exposure, industrial equipment, network infrastructure, grid modernization, commodity-linked supply chains. This wave is where the market feels like it's in an expansion boom, because it is. And then comes wave 5, and wave 5 is the part that makes this whole thing dangerous: inflation. Because if trillions flood the system, prices react. Not always immediately in groceries and gas. Sometimes the first inflation shows up where? Assets, stocks, real estate, commodities, gold, silver, Bitcoin. And people don't call it inflation when it's assets. They call it a bull market, but it's the same thing. Your purchasing power is being repriced. And if you're holding cash while assets reprice higher, you're getting poorer without realizing it. That's why I say it over and over again. Cash is trash in a liquidity cycle. Now here's the twist. If the Fed stays accommodative while inflation heats up, you can get a melt-up, a real one. The kind of market that makes no sense to people sitting on the sidelines. They'll say it's irrational. They'll say it's manipulation. They'll say it can't last. And it will last longer than they can stay skeptical, because liquidity beats logic. But if inflation accelerates enough, eventually the market forces a reaction. Maybe yields rise, maybe credit tightens, maybe the Fed signals a shift, and that's where you need to rotate, because high valuation growth doesn't love rising yields. Energy and commodities start taking over. Inflation hedges start outperforming. That's where gold and silver become crucial. That's where real assets shine, and that's why this isn't about one trade. It's about surfing the entire liquidity cycle without getting wiped out when the current changes. Now let's talk sectors, the 6 areas that tend to absorb the most capital first. Sector 1, consumer discretionary, because consumers spend first: home improvement, retail, travel, lifestyle upgrades, the feel-good economy. Sector 2, technology and mega caps, because that's where buybacks concentrate, and it's where institutional money parks when it wants growth with liquidity. Sector 3, financials, because more investing means more brokerage flows. More corporate activity means more deal fees. More consumer spending means more transaction volume. Sector 4, industrials and infrastructure, because capex incentives turn into real spending fast. Sector 5, energy and commodities, because inflation and supply constraints show up here when the system overheats. Sector 6, real estate and real assets, because liquidity loves hard assets, and housing, REITs, infrastructure ownership, those become the long-duration beneficiaries. Now let me give you the part everyone wants, the timeline. Here's how I would think about this type of cycle. Phase 1, positioning. This is where smart money buys before the headlines. Phase 2, consumer wave. This is where spending drives earnings. Phase 3, corporate wave. This is where buybacks and repatriation drive indexes. Phase 4, capex wave. This is where industrials and real economy run. Phase 5, inflation wave. This is where commodities, gold, silver, and alternative stores of value accelerate. Phase 6, rotation and defense. This is where you take profits, reduce risk, and reposition for what comes next. That is the playbook. And if you understand that, you stop acting like the market is random, you stop chasing, you stop panicking, and you start thinking like a macro investor. Now, can this go wrong? Of course, there are always risks. Consumers could save instead of spend, but if they save, that money still enters the financial system. It still flows into assets. It still supports markets. The Fed could change direction. The political environment could shift. Something external could disrupt the cycle. But here's what I know: liquidity. Events don't get ignored. They get priced, and most people don't see it until it's already happened. So here's the bottom line. A major liquidity wave is coming. It's going to hit in phases. It's going to reprice assets. It's going to create opportunities that only happen a few times in your lifetime, and you have a choice. You can ignore it. Sit in cash. Wait for confirmation. And watch the market leave without you. Or you can understand the map, position intelligently. Ride the waves, rotate with the cycle, and put yourself on the winning side of the biggest wealth transfer moments you'll ever experience. That's the difference between people who build wealth and people who watch other people build wealth. Now, if you got value from this, do 3 things right now. Hit like, subscribe, and comment below. How are you positioning for this cycle? Are you leaning into growth? Small caps? Mega caps? Real assets? Gold and silver? I read the comments and I want to know how you're thinking, because this is the moment where preparation becomes profit. Stay sharp, stay disciplined, and remember, money doesn't reward the loudest person. It rewards the person who moves before the crowd understands why. I'll see you in the next one.